Hey, what's going on everyone? It's Griffin here and I hope you're all enjoying your day. So in today's video, we're going to be speaking about dividends and more specifically, dividend distributing exchange traded funds, ETFs for short, both in the American as well as the Canadian market for that investment diversity. Now, a couple weeks back, we spoke about some of my favorite Canadian individual dividend stocks, as well as some of my favorite Canadian exchange traded funds that you can check out in both of those videos. If you haven't already checked those out, definitely do. The audience really enjoyed them. But in today's video, we'll be speaking about some exchange traded funds that focus on those dividend distributions more than they do on capital appreciation. And by the way, there are hundreds of different dividend-focused ETFs to choose from that trade on North American exchanges. So I've sifted through hundreds of different options and have targeted a handful that offer some of the most attractive yields net of fees, lower management expense ratios, as well as maintaining some of that capital appreciation and or preservance of that capital so that over time, your actual investment isn't deteriorating in value, thus nullifying that dividend income. And before we go any further, I'd like to mention the fact that today's video is sponsored by Start Engine, which is a crowdfunding startup platform, but more on that later. Alright, so jumping into the first dividend-focused Canadian ETF here, we have the BMO Canadian Dividend ETF, ticker symbol ZDV on the TSX. And this ETF is an equity-focused fund that actually utilizes a rules-based methodology that considers the 3-year dividend growth rate, yield, and payout ratio of the underlying holdings to determine their respective weights within the fund. So naturally, being a Canadian dividend ETF here, well, the holdings are mainly concentrated at 41% in financials, 14% in energy, 12% in utilities, and the list goes on, with slight exposure to other industries. The largest position in the ZDV fund is Enbridge at right around 5%, followed by RBC, TD Bank, and Bell Canada, which are typical candidates for Canadian dividend stocks. Now, shares of ZDV trade for right around $20 per share, making it highly accessible to any investor who may be interested in it, and over the past 12 months, the fund has appreciated by right around 25%. That said, when we zoom out over a 5-year period, we can see that the fund has had some rocky trading, making this very much a dividend-focused position. Right, so at the current 12-month trailing yield of right around 3.9%, net of that 0.39% management expense ratio, we're looking at an average annualized return of 8.9% over the past 5 years, and total cumulative returns over the same time frame of around 53.4%. So again, this is an ETF that's going to be mainly beneficial for that recurring dividend income towards a portfolio over, say, the capital appreciation of the underlying holdings. What's also interesting about this ETF though, and that might be appealing to some investors, is the fact that it pays out their distributions on a monthly schedule. Now again, in the big picture, this doesn't really change anything because the amount of dividend distributions from a cash value that any investor is getting over that 1-year time frame remains the same whether or not it's on a monthly, quarterly, or even annual schedule, but still some people like that monthly income. Okay, moving on to the second dividend-focused Canadian ETF we'll be speaking about today, we have the iShares Composite High Dividend Index ETF, ticker symbol XEI, that currently trades for right around $25 per share. And this is an ETF that's holdings and returns are quite similar actually to the BMO Dividend ETF that we just looked over. So holding both of these ETFs in the same portfolio wouldn't really make any sense as there's quite a few overlapping positions. So compared to the BMO ETF though, that had right around 40 positions, this ETF has about 75 positions held within the fund, some of which are overlapping again to that BMO ETF. However, there is a bit more exposure to the energy and communication sectors, although financials remained one of the largest sectors, still at 30.2%. So actually the top holdings though do differ quite a bit, where Canadian Natural Resources is the largest position at 5.8%, followed by TD, Suncor Energy, and Nutrien Ltd. Now, even considering the fact that the management expense ratio of this fund is slightly lower at 0.22%, well, the dividend yield net of this MER is 3.85%, which still remains lower than that of the BMO ETF, which is interesting. So let's take a look at the total returns then. When taking account both capital appreciation and dividend income, the average annual returns of the XEI ETF over the past 5 years are 9.13% and cumulative returns of 54.8%. So just a tiny bit higher than that of the BMO fund. So in reality, holding one of these funds over the other has actually yielded investors similar results and would come down to personal preference for industry exposure. Alright, now moving into the third and last dividend-focused Canadian ETF for today's video, we have the BMO Canadian High Dividend Covered Call ETF, ticker symbol ZWC.TO, that trades for around $19 a share. And by the way, I'll mention right out the gate here that this type of ETF is completely different than the two previous ones that we just looked at that are literally just investing in these equity positions, and investors are benefiting from that diversified exposure and diversified dividend yield that comes with one of those positions. I'm including this covered call ETF in the video because I've had quite a few people ask me to comment on the fund, as the dividend yield right now is quite attractive at around 6.4%, and considering the fact that in the current market environment any yield above 4 to 5% can be difficult to accomplish, 6.3% is definitely quite nice. This is the whole goal of a covered call ETF in the first place, though, to create more income for the investors of the fund by utilizing call options. And since we rarely speak about options on this channel, let's quickly cover what a call option is in the first place if you're not sure what it is. So in really simple terms, a call option is essentially a contract between two separate parties where the buyer of the option has the right to purchase the stock from the seller of the option at a given price for a certain period of time. And from there, the buyer pays the seller a premium for that option to purchase the stock at a given price. That's pretty much a call option in a nutshell, and a covered call ETF will utilize this strategy over and over again to create more income for the fund that is then distributed out to shareholders for that higher dividend yield. So with this in mind, the BMO ZWC ETF is just that. It's a covered call ETF that utilizes call option premiums to create higher income for the fund in question, and that's why it's able to offer investors a higher dividend yield, but usually this is at the detriment of capital appreciation of the underlying holding itself. In fact, around a year ago at this point on the channel, I did cover the ZWC ETF, the one we're speaking about right now, and at the time, considering its lower price point, the dividend yield was at around 7.5%. Now, taking a look at this fund's holdings, though, we'll notice right away that they are extremely similar to the previous two ETFs, including TD, RBC, BCE, etc. So in reality, although the fund has a yield around 3% higher than the two previous ones, what's then the catch? The main thing to keep in mind with a covered call ETF is that the fund is going to be utilizing call options to sell the underlying assets that it holds above the strike price of the calls to make that higher income. So it's sort of a trade-off for the capital appreciation, and this can also lead to more volatility in the actual dividend income itself. Right, so considering this reality, if we take a look at the ETF's market movements, we can see that over the past 5 years, the chart pattern is actually quite similar to the previous two ETFs, although over this past 5-year period, the initial capital would have lost right around 5% of its value. So what will then be important to look at are the cumulative returns over this same 5-year period to see if that higher dividend income makes up for the capital loss. And actually, this fund doesn't have 5 years of trading history, but we can see that cumulatively over the past 3 years, this fund has returned investors a total of around 29%, and this is in contrast to the ZDV funds 42.5% in the same period. Right, so what's important to take out of this is that the dividend yield is quite a bit higher, but the actual capital growth of the underlying assets and the money you're putting in has squandered quite a bit, where over that same period, even with a lower dividend yield, well, considering that those other funds returned investors higher appreciation of the actual capital itself, this has resulted in overall higher cumulative returns. So yeah, a covered call ETF could come into play in an overall portfolio strategy if you're really focused just on that shorter term recurring higher dividend income. However, in the big picture, if you're looking to hold it over the long term, there's definitely quite a few more factors to consider in that overall decision. All right, so we're halfway through today's video speaking about dividend-focused exchange-traded funds, and before we hop into the American positions, let's take a second to speak about today's video sponsor, Start Engine. So when Start Engine reached out to me, I was really intrigued by the platform that they've developed that allows startups and entrepreneurs to raise capital for their projects through a crowdfunding model. This is similar to the way that you can back a project on other crowdfunding platforms, although Start Engine actually allows you to gain equity in the startup or project that you're backing, making it a completely new investment for your portfolio. In fact, taking a look at Start Engine's website, we can see the diversity of startups that have used the platform to raise capital firsthand, with companies ranging from tech, healthcare, 3D printing, distilleries, and many more that all offer investors completely different investment opportunities. Now, investing in startups can definitely be riskier than other investments that are more common, and the reality is that most of us don't have all too much experience investing in startups in the first place. So instead of just jumping over to the platform and investing in a new startup, Start Engine actually wanted me to encourage you to download a free digital pamphlet covering 5 things investors should know before investing in startups to get you up to speed with the space of investing in startups. Overall, to date, there have been more than 600,000 prospective investors that have used Start Engine, raising over $450 million in capital for startups that have used the platform, 200 million of which was in the last 12 months alone. So this is a platform that's definitely gaining popularity and recognition in the marketplace. So if you're interested in potentially investing in a new startup, make sure to check out Start Engine, but also don't forget to download their PDF to get you up to speed with 5 things to know before investing in a new venture. So with that said, let's get back to today's video. Alright, so that about covers it for the Canadian dividend-focused exchange traded funds. Let's now go south of the border and speak about some American dividend positions. Now, in the American market, there are quite a few more options for dividend-focused exchange traded funds. And at first glance, if you search for some of these ETFs online, I want you to look a little bit further than, of course, just the front-facing dividend yield to actually look at overall cumulative returns of these funds over time, taking into account both dividend income as well as that capital appreciation, because ultimately, if you're holding these longer term, that's what matters anyways. For example, taking a look at the Super Dividend ETF, ticker symbol SDIV, we can see that although the 30-day SEC yield is around 8.8%, the cumulative return since inception of the fund back in 2011 is only 15.3%. So this is obviously not the type of investment that we're necessarily interested in, even though the front-facing dividend yield is extremely high. So with this in mind, let's take a look at the first US dividend-focused ETF, and that would be the WisdomTree US High Dividend Fund, ticker symbol DHS on the NYSE. I'm starting with this ETF because it offers investors diversified exposure to over 300 of America's top dividend distributing companies, making it a great first option potentially for a dividend-focused American account. Now, this fund is a bit on the smaller side for a US fund at roughly 800 million in assets under management with exposure to multiple sectors across the United States, roughly 19% in consumer staples, 18% in financials, and around 14% in healthcare. Now, in terms of individual holdings, we're looking at Pfizer in the top spot at 5.8%, AbbVie at 5.3%, and Philip Morris at 5.1%. As of the time of filming this video, DHS trades for right around $80 per share and has a dividend yield of 3.6% that's paid out on a monthly schedule and net of the management expense ratio of 0.38%, meaning investors would only pay $38 per year on $10,000 invested in this ETF. Now, when taking a look at this fund's returns over time, we can see that it's returned investors an average of 10.95% per year over the past 10 years. So as with most dividend-focused ETFs, this is definitely an ETF that is focused more on that recurring dividend income for investors. However, taking a look at cumulative returns over a 10-year period, this is also a fund that does have some slow and steady capital appreciation for overall nice annualized returns when taking into account dividend as well as capital appreciation. Okay, moving on to the second American dividend-focused ETF, we have the Invesco Preferred ETF, ticker symbol PGX, which is quite a bit different than the other ETFs that we've covered in today's video, and that this fund holds preferred shares of the underlying securities that it holds. If you're new to investing, you might actually not be aware of the fact that most public companies offer 2 different classes of shares, being ordinary or regular shares as well as preferred shares. And 99% of the time, if you've purchased stock of any company, you are purchasing the regular shares. Typically, one of the main differences between those ordinary and preferred shares, though, is that with the preferred shares, there's a higher focus on consistency and stability of the dividend income that's also on a more set schedule. So in this case, the PGX ETF invests in companies such as as Citigroup, JP Morgan, Wells Fargo, and so forth, as we can see from the top underlying holdings. And for this reason, you can kind of think of this fund as being similar to a fixed income instrument where the distributions are very much on a fixed schedule, but usually come with a trade-off of lower capital gains. Let's now take a closer look at the holdings of the PGX ETF. So we can see that around 66% of this fund is made up of companies in the financial sector, 10.5% in utilities, and around 8.3% in real estate. So definitely a fund heavily focused towards preferred shares in the financial sector. This ETF trades for right around $15 per share at the time of filming the video and has a dividend yield that's a bit higher at 4.6%, net of the 0.52% management fee. The dividend distributions are also on a monthly schedule, and remember how I said earlier that typically preferred shares will have a higher yield but come at the detriment of capital gains. Well, if we take a look at this ETF's chart over the past 5 years, we can see that the actual investment itself has only fluctuated slightly for a return of around 4%. With that said, any investor who's considering investing in preferred shares or an ETF that holds preferred shares is very much focused on more of that fixed recurring income, treating it even somewhat more as like a bond ETF. Even though they are completely separate, this is more similar of a comparison than ordinary shares. And then finally, the third and last American dividend-focused ETF, let's cover a covered call ETF with the Global X NASDAQ 100 covered call ETF, ticker symbol QYLD. Now, as with the BMO covered call ETF that we spoke about previously in the video, this is once again a fund that is creating higher returns for investors through those covered call premiums. Now, with covered call ETFs, keep in mind, this is not the type of position that is suitable for all types of investors. And when taking a look at the cumulative global returns over time, typically covered call ETFs do underperform the S&P 500 and the global market. However, this is the type of ETF that does offer investors a higher dividend yield on typically a monthly schedule. So in the case of the QYLD ETF, it is currently trading for around $22.50 a share, and it's offering a whopping 11.8% yield. And this ETF has also maintained a monthly distribution schedule for now 7 years, where it's writing call options on the NASDAQ 100 index. Now, this fund has net assets of around $5.3 billion and a total management expense ratio of 0.6%. So as with most covered call ETFs, if you're looking for that higher yield and monthly distributions, this type of ETF could potentially be suitable for you. However, it's important to consider all the factors in your overall decision. And when looking at this cumulatively since inception of this fund, which was back in 2013, we can see that the cumulative returns are 107%. And on the flip side, if we take a look at the cumulative returns of just the actual NASDAQ 100 over roughly this same 10-year period, we can see that over the past 10 years, the NASDAQ 100 index has returned investors over 500%. So basically in today's video, I'm offering investors a look at different types of dividend-focused exchange traded funds, some strictly equity and some utilizing call options to create higher income. But really, it's important that you take a look at your overall investment strategy and what you currently have in your portfolio anyways to take a decision on if any of these are right for your needs as an investor and your overall portfolio right now. With that said, I hope you enjoyed today's video. If you did, make sure to smash the like button, subscribe to the channel for more, and also check out all the other pieces of content on dividend investing and stock market investing in general already posted on the channel. I'd also recommend that you take a look at all the links down below to resources I use and recommend, as well as a Black Friday sale on my stock market investing course that is only going to be available until around Monday, which is Cyber Monday, pretty sure. So with that said, thanks a lot for watching today's video. There's lots more coming this week. I will see you in the next one.